Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fresh Del Monte Produce Inc. Annual Report. Fresh Del Monte Produce Inc. offers a diverse range of businesses and services across various segments. The company's primary focus lies in the production, marketing, and distribution of fresh and value-added fruits and vegetables globally. Its product portfolio includes pineapples, fresh-cut fruit and vegetables, melons, non-tropical fruits such as grapes and apples, and other specialty items like avocados. In addition to its core business, Fresh Del Monte Produce Inc. also engages in the sale of poultry and meat products, providing a comprehensive range of protein sources for consumers. Furthermore, the company offers third-party freight services, expanding its reach into logistics and transportation. The company markets and distributes its products through various channels, including retail stores, club stores, convenience stores, wholesalers, distributors, and food service operators. Fresh Del Monte Produce Inc. operates under multiple brands, such as Del Monte, UTC, Rosie, Just Juice, Fruitini, and others, catering to different regional markets and consumer preferences. Overall, the company's business scope encompasses a wide range of products and services, from fresh produce to meat and poultry, logistics, and beverages, making it a significant player in the global food industry. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what could cause a stock price to increase. The stock price of Fresh Del Monte Produce Inc. has increased in the past year due to several factors. One major reason is the company's strong financial performance. A consistent increase in revenue and net income indicates that the company is successfully executing its business strategies, which boosts investor confidence and drives up the stock price. Another factor contributing to the rise in stock price is the company's expansion into new markets. Fresh Del Monte Produce Inc. has been actively exploring opportunities in emerging markets such as Asia and Latin America, which has helped increase its global presence and revenue streams. This strategic move has not only expanded the company's customer base, but also provided a competitive edge over its peers. Additionally, the company's focus on sustainability and social responsibility has also contributed to its stock price growth. Fresh Del Monte Produce Inc. has been actively implementing sustainable practices in its operations, such as reducing water usage and waste management. This commitment to corporate social responsibility has not only improved the company's reputation, but also attracted socially responsible investors who are willing to pay a premium for stocks of companies that align with their values. Lastly, the overall market conditions have also played a role in the increase in stock price. A strong economy and low interest rates have created a favorable environment for investors to take on more risk and invest in growth stocks like Fresh Del Monte Produce Inc. This has led to an increase in demand for the company's shares, driving up its stock price. In conclusion, the combination of strong financial performance, strategic expansion into new markets, focus on sustainability and social responsibility, and favorable market conditions have all contributed to the increase in Fresh Del Monte Produce Inc.'s stock price over the past year. Fresh Del Monte Produce Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Fresh Del Monte Produce Inc. trades at a higher price-to-earnings ratio of 25 times and a similar price-to-book ratio of 0.98 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 2.9%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline at Del Monte Pacific Limited can be attributed to several key factors. On the growth side, an increase in product sales, changes in customer volume rebates, and a shift from recording revenue over time to point-in-time for third-party freight and logistics services business contributed to revenue growth. Additionally, a decrease in advertising and promotional costs also played a role. On the decline side, underperformance in the vegetable business in North America, reduction in forecasted cash flows, and underperformance in prepared foods business in North America and Europe were major contributors to revenue decline. Furthermore, an increase in discount rates used and sustained decline in actual and projected sales and gross margins for Mann Packing also negatively impacted revenue. Geographically, Asia revenue declined by 9% in 2025 compared to 2024, while Europe revenue increased by 7% in 2025 compared to 2023. Segment-wise, fresh-cut fruit and vegetables revenue increased by 8%, while pineapples revenue increased by 13%. However, avocados revenue decreased by 30% in 2024 compared to 2023, and banana revenue decreased by 9% in 2025 compared to 2024. Overall, Del Monte Pacific Limited's revenue growth or decline was influenced by a combination of these factors, which highlight the importance of geographic and segment diversification, effective cost management, and accurate forecasting. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased from -$1.6 million in 2023 to $141.6 million in 2024, indicating a substantial improvement. However, this trend was short-lived, as the net income dropped again to $93.5 million in 2025. The subsequent years saw a continued decline in net income. The profit margins also experienced changes during this period. The gross profit margin increased from 8.13% in 2023 to 9.23% in 2025, indicating an improvement in the company's ability to maintain its prices relative to costs. On the other hand, the operating income margin decreased from $196.3 million in 2024 to $137.4 million in 2025. The reasons behind these changes are multifaceted and include fluctuations in banana prices, tariffs and trade policies affecting business operations, increased costs of raw materials and labor, volatile market prices for fresh produce, impairment charges, and changes in foreign currency, cash flow hedges, and interest rate swaps. These factors contributed to the volatility in net income and profit margins during this period. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the net cash provided by operating activities for 2025 was a significant $245.1 million. This confirms that the company is indeed generating positive operating cash flow, which is a crucial indicator of a company's financial health and stability. The consistency in this figure across different pages further reinforces this conclusion, providing confidence in the accuracy of the data. The company's debt level and interest expenses have undergone significant changes over the years. Initially, the debt level decreased substantially, with long-term debt decreasing from $248.9 million to $176.2 million. However, operating lease liabilities increased, while finance lease liabilities decreased. In terms of interest expenses, there was a notable decrease of $12.9 million between 2023 and 2025. This reduction is attributed to the termination of an interest rate swap agreement. The company's financial reports indicate that interest expenses have changed significantly due to this event. The performance of various segments and regions in the market has been mixed, with some showing significant growth while others have struggled. On the positive side, the avocado segment in North America has performed well, as has the banana segment in both North America and Europe. Additionally, fresh and value-added products in North America have seen a substantial increase in net sales of $2,516.1 million in 2025. Central America has also experienced growth, with an increase in net sales of $1,082.7 million. However, some segments and regions have underperformed. The pineapple segment and prepared foods segment have struggled, as have fresh and value-added products in general, which saw a decline in net sales of $35.8 million in 2025. Within the banana segment, there was also a decrease in net sales of $148.6 million in 2025, building on a decline of $62.3 million in 2024. Furthermore, Asia and the Middle East have experienced decreases in net sales, with Asia seeing a drop of $72.6 million and the Middle East experiencing a loss of $12.7 million. The management of the company is optimistic about its outlook and strategy. They are committed to expanding their operations through strategic acquisitions and investments in new markets, such as avocados and pineapples. This growth strategy aims to drive future growth and profitability. To achieve this goal, management is focused on improving operational efficiency by reducing costs and investing in unconsolidated companies in the food and nutrition sector. They are also using derivative financial instruments to manage risks associated with foreign exchange and interest rate fluctuations. The company's strong financial position allows it to invest in share repurchases and capital expenditures, which are expected to be around $60 million to $70 million in 2026. Management is committed to its long-term strategy, which includes investing in specialty ingredients business to drive future growth. However, there are some potential risks and challenges that the company needs to address, including impairment of goodwill, inflationary pressures, and regulatory compliance. Despite these challenges, management's focus on operational efficiency, investments, and risk management suggests a positive outlook for the company's future performance. Acquisitions and divestitures are significant business transactions that can have a substantial impact on a company's operations and financials. In the context of our company, there have been several notable acquisitions and divestitures in recent years. One of the most significant acquisitions was the purchase of select assets of Del Monte Foods Corporation, II Inc., and its affiliates for approximately $285 million, plus assumption of certain liabilities. This acquisition included prepared and packaged foods businesses, a bubble tea business, facilities in the U.S., Mexico, and Venezuela, as well as global ownership of the Del Monte brand. Another notable acquisition was the purchase of Mann Packing, which was initially acquired with a 25% non-controlling interest in 2018. The remaining 75% stake was purchased in June 2023 for an undisclosed amount. In terms of divestitures, our company sold its Mann Packing business to a third party in December 2025 for $19 million plus a variable amount based on inventory at closing. This sale included the production facilities in Gonzales, California, which were leased to the buyer. Overall, these acquisitions and divestitures demonstrate our company's strategic focus on expanding its operations and portfolio while also optimizing its assets and resources. The company has demonstrated its commitment to returning value to shareholders through two key initiatives. Firstly, it has a history of paying dividends, with a consistent payout of $0.30 per share in all 4 quarters of 2025. This indicates a stable and reliable approach to dividend payments. In addition to dividend payments, the company has also engaged in share buybacks, repurchasing 865,773 shares for $29.8 million in fiscal 2025. This strategic move allows the company to reduce its outstanding share count, potentially increasing earnings per share and benefiting shareholders. Concerns about inventory buildup or supply chain disruption are evident in the company's operations. One of the primary concerns is the potential for inventory buildup due to single-point failures in the supply chain. For instance, 94% of Philippine-sourced bananas came from one grower, making it a significant risk if that supplier were to experience any disruptions. Additionally, there are concerns about tariffs and trade policies impacting products sourced from Mexico, which could lead to elevated commodity and supply chain costs due to market conditions. The expiration of contracts with major suppliers, such as the one in Philippines, also poses a threat to inventory buildup. The company's operations have been affected by various external factors, including shipping disruptions in the Red Sea and surrounding waterways, logistical pressures, and geopolitical conflicts. These disruptions have negatively impacted business, leading to reduced supply in Asia and lower sales volumes due to weak market demand and adverse weather conditions. Furthermore, the company has experienced inventory write-offs incurred as a result of Hurricane Beryl, which highlights the vulnerability of its operations to natural disasters. The fluctuation in inventory levels, with an increase from $2.5 million in 2024 to $2.5 million in 2025, followed by a decrease from $595.3 million to $581.9 million between 2024 and 2025. also raises concerns about the company's ability to manage its inventory effectively. Overall, the company faces significant risks related to inventory buildup and supply chain disruption, which could have a material adverse effect on its business if not addressed promptly. That concludes the financial summary for Fresh Del Monte Produce Inc. Feel free to comment below, and I will be happy to answer them when possible.